If you remember only one thing from this entire series, let it be this decision map. It's the difference between gambling and systematic trading. Most traders fail because they treat options like lottery tickets, skipping the vital analytical steps required for consistency. We are going to fix that today by visualizing the entire decision process in one master framework. This is the blueprint that connects every concept we have covered in this series. We organize this system into 5 specific gates that a trade must pass before you even consider opening your broker platform. If a trade idea gets stuck at any gate, it is rejected immediately. This filter protects your capital from impulsive, low-probability decisions. Gate 1 is defining the bet clearly. What is your hypothesis on direction, volatility, and time? You must have a view on where price is going, how fast it will get there, and by what date. Without these 3 coordinates, you are navigating without a compass. Gate 2 analyzes the market regime. Is the underlying asset trending strongly, stuck in a range, or exhibiting chaotic behavior? A trend-following strategy will bleed money in a chopping range, while a range-bound iron condor will be destroyed by a breakout. Gate 3 is volatility pricing, specifically looking at IV rank or IV percentile. This determines if options are expensive or cheap relative to history. Generally, we want to be net sellers of options when IV is high and net buyers when IV is low. Gate 4 defines the risk structure, forcing you to choose between defined risk and undefined risk. Defined risk spreads cap your losses but lower your probability of profit. Undefined risk offers higher probabilities and flexibility, but exposes you to tail risk or catastrophic loss scenarios. Gate 5 is the psychological check. Can you execute this trade without emotional distress? If the position size keeps you awake at night, the trade fails this gate regardless of the math. Your system must align with your personal risk tolerance. Once we pass the gates, we move to Section 2, Strategy Families. Instead of memorizing dozens of strategy names, group them by their function. This simplifies selection drastically based on the criteria we just established. For directional plays, we lean on vertical spreads or long options to capture delta. For income and neutral markets, we look at short volatility structures like iron condors. For explosive breakout potential, we look at long volatility structures like straddles. Now we overlay Section 3, the trade life cycle. A strategy is not just an entry point. It is a continuous loop of management. You must define your exit triggers for profit, loss, and time before you enter the trade. Common mechanical rules include taking profit at 50% of max profit or rolling the position at 21 days to expiration. Having these rules written down removes the emotional burden of decision-making during market volatility. The final component is Section 4, the portfolio check. A trade might look perfect in isolation, but does it dangerously concentrate your risk? We need to zoom out and look at the aggregate exposure. Check your beta-weighted delta. If your portfolio is already heavily long the market, adding another bullish trade increases your correlation risk. Sometimes the best trade is the one that balances your existing portfolio. We also check net vega. If a market crash causes volatility to spike, will your entire portfolio suffer? Balancing short vega income trades with some long vega hedges creates a more robust equity curve. This leads us to the complete decision system. It flows from environment to pricing to structure to risk and finally to execution. This map ensures no critical variable is ever overlooked. When you follow this system, you stop guessing and start operating like a business. The anxiety of what if is replaced by the confidence of if this, then that. This is the hallmark of a professional trader. Here is the full master decision map on screen now. I strongly suggest you screenshot this or print it out. Keep it on your desk and run every single trade idea through this gauntlet. If a trade fails at any step, if the IV is wrong, the trend opposes you, or the portfolio risk is too high, you simply do not trade. Cash is a valid position. Protecting your capital is job number 1. This series has given you the tools. Now it is up to you to build the discipline. In the next season, we will apply this framework to live market examples and case studies. Remember, environment, pricing, structure, risk, execution. Master this flow, and you master the options market. Screenshot the map. Build your process. See you next season.